I want to talk to you about tax deductions you can claim without receipts. Sometimes you want to claim so you want to write something off, but you don't have the receipts. So into this conversation, I'll answer all the questions that you have around tax deductions you can claim without receipts. So here's an overview I want you to pay attention to. The thing here is that the IRS does allow certain deductions to be claimed without receipts, and it's important to know those deductions, okay? So first of all, you have self-employment taxes. So if you are self-employed, you are responsible for paying your own Medicare and Social Security taxes, also known as self-employment taxes. This lets you actually deduct half of those taxes from your income, lowering your federal income tax bill. If you use tax software to prepare your return, the software will automatically calculate the amount to deduct. Then you also have home office expenses. So if you have, let's say, if you have a home-based business, you may be able to deduct a portion of your rent or mortgage, utilities, insurance, and other home-related expenses under something called the home office deduction. Remember that I use the term you may be able to, okay? So the key here is that you must use your home office exclusively for business purposes. A dedicated room is not required, but the space must not serve for any other purpose. And the cool thing is that you don't need receipts for most home office expenses, but you should have other documentation such as rent. So here we're speaking about canceled checks or bank statements, and a copy of your rental agreement can document rent expenses. You also have mortgage insurance. Mortgage interest rather. So your lender should send you a Form 1098 showing how much mortgage interest you paid during the year. You may also find this information by logging into your account online. And you also have real estate taxes. And so you can usually find this information on your Form 1098, an annual statement from the county's assessor's office, or by looking up your property on the assessor's website. You also have utilities, so you can actually access copies of your monthly utility bills or payment history in your online account. By the way, I mentioned earlier mortgage insurance. You can actually write off part of your mortgage insurance also, not a problem. You also have self-employed health insurance premiums. So if you're self-employed and have health insurance, you can deduct the cost of your premiums from your taxes. This deduction is available even if you don't claim out-of-amount deductions on Schedule A. So if you don't have receipts, use a copy of your policy's declaration page or download your payment history from your insurance company's website. By the way, boss, I want to quickly remind you of today's, first of all, I want to welcome you to the show. Thank you so much for being here. You are going to enjoy today's conversation. Next, you have self-employed retirement plan contributions. So basically contributing to a qualified retirement plan like a traditional IRA, you have SEP IRA or solo 401k is not only good for your future, financially speaking, it's also great for lowering your tax bill in the present. So the amount you can actually deduct will depend on the type of retirement plan you have, but regardless, it's worth taking advantage of this deduction if you can. So the institution that really manages your account should report all contributions made to the account during the year on Form 5498. So the form is called 5498. You may also be able to find the information on your year-end statement. So you also have vehicle expenses. So if you use your personal vehicle for work-related purposes, you can deduct the cost of gas, repairs, and depreciation. However, there is a simpler way to do this than collecting receipts and calculating all those costs individually. That means you have to use the standard mileage rate. So the standard mileage rate, fantastic. So the standard mileage rate is a set amount per mile that you can actually deduct for business use of your vehicle. So this year it's about 63 cents per mile, and this amount changes all the time. So there are a few things to keep in mind when using the standard mileage rate though. If you also use the vehicle for personal reasons, you can only claim tax deductions for the portion of miles driven for business purposes. You must keep records of how many miles you drove for business purposes during the tax year. So people often miss expenses like this come tax time because they think they need receipts, but no. And it's important to understand that you can actually just claim those expenses without any sort of substantiation. You also have cell phone expenses. So business owners who use a cell phone for business purposes can deduct a portion of the cost of their service plan. So to calculate your deduction, you want to multiply the cost of your monthly service plan by the percentage you use for business. Somewhere between 30% to 50% is typical. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about tax deductions that you can claim without receipts. I want to talk to you about the IRS rules in terms of the business entity that you have. And so the rule for income tax write-offs vary by business type or entity. For example, self-employed taxpayers can deduct their health insurance premiums. However, businesses structured as S corporation can deduct these premiums on the business tax return, while the owners of other pass-through businesses deduct these expenses on Schedule 1, which gets filed with their Form 1040. Okay, so there's a difference of configuration here. So additionally, one thing I need to say here is that owners of S corporation cannot take the home office deduction. If you have a home office you use for business, you can have the company pay you rent for the home office, but those rent payments are taxable income on your individual tax return. So you also have the option of reimbursing yourself for the cost of maintaining your home office under what they call an accountable plan. However, this strategy requires a written plan documenting what expenses are allowable, completing monthly expenses reports, and submitting receipts for any expenses you plan to reimburse. Okay. And also, if you want to create an accountable plan for your S corporation, it's always a great idea to discuss the requirements with your CPA to ensure you are handling things correctly. And it's important to understand that when we talk about handling things correctly, what you really want to avoid here is that you want to avoid, IRS audits. You want to avoid investigations by state tax authorities. So you just want to be on the right side of the law. And remember that when we talk about expenses that you can claim without receipts, I mean, those generally apply to what the IRS is looking for. Maybe your state tax department is way more sort of convenient or way stricter than ever. So everything depends upon your situation. One thing I want to say here is that you always can actually avail yourself of those, you can call the authorities to have a clear idea what's possible and what's not possible in your specific state. Now, the thing here is that there are some deductions that do require receipts. And the thing is that if you do not have the receipts, can you use bank statements instead? Well, it really depends. Bank and credit card statements can provide some documentation for tax credits and deductions, but they are usually not sufficient on their own. So those statements do not show all the details that the IRS requires. So because the IRS wants to have the payee, the amount paid, the date incurred, and a description of the item or service showing the purchase was business related. So this is very important. Let me give you an example. Let's say your bank statements might show that you spent $135 at Costco on December 1st, but an IRS auditor cannot tell from the bank statement whether you purchased office supplies or groceries for home. Now, what other tax return documentation can you use if you don't have a receipt? If you don't have receipts, you want to keep as much alternative documentation as possible to support your tax deductions, okay? Some examples include you have canceled checks or bank statements, you have credit card statements, you have invoices, you have bills, you have account statements, you have purchase and sales invoices, you also have contracts, transaction histories, you have duplicate records from vendors and suppliers, you have calendars showing travel expenses, client meetings, and business meals, and you have cell phone records. So the bottom line here is that you have to be as granular and transparent as possible. But you always have to put yourself in the IRS shoes in terms of transparency, because what kind of information does the IRS want? Going back to what I said earlier, the IRS requires the payee, the amount paid, the date incurred, and the description of the item or service showing the purchase was business related. And one thing I also need to say here is that when we talk about tax deductions you can claim without receipts, remember again that the rules are different, whether you're speaking about the federal taxes, federal income taxes versus state income taxes. So always inquire with authorities in your state to have a clear idea what the requirements are at the state level, but also at the city level. Boss, I want to quickly remind you of today's topic. We are having a conversation about tax deductions that you can claim without receipts. Let me give you a few pro tips here as we actually get a little deeper into the discussion. It's important to understand that if you don't have receipts to actually claim some certain tax deductions, you are going back to the standard deduction, right? Because when we talk about showing tax receipts, is because you're trying to itemize. You're trying to itemize your deductions, so you're having itemized deductions versus instead of the standard deduction. But if you don't have the proper receipts, you're gonna have to revert back to the standard deduction. So the standard deduction is actually a fixed amount of income that is not taxed. So individuals or married couples can claim this standard deduction each year, and that amount of income is removed from their taxable income. And so it's one of those things where the number changes every year. So just wait for the IRS tax season to have a clear idea about how much the IRS is charging you. But for individuals, we are looking at 13 grand all the way to $15,000, and that's actually money that's taken from their taxable income as the standard deduction. This means that their taxable income was reduced by $13,000 to $15,000. Married couples who file jointly could deduct 25 grand all the way to 27 grand. So a head of household with dependents but filing individually could claim like 20 grand all the way to 22 grand. So using the standard deduction also means you cannot then itemize deductions, and you have to either choose the standard deduction amounts or itemized deductions. You cannot claim both. It's also important to know that the standard deduction amounts change yearly to match inflation. So that's why I was just telling you, you have to wait for the IRS to publish this year's number this year's numbers, so you have a clear idea how to actually roll. And so make sure you understand that the deduction changes when filing your current taxes, because the last thing you want is to actually file your taxes, everything is fine, and then you get audited by the IRS and they ask questions that you don't have the answers for. And so this is not really good. You want to be on the right side of the law, and you want to actually, if you claim the itemized deductions, in other words, if you're itemizing deductions, just make sure that you have the proper documentation to substantiate anything that you claim on your tax return. One thing I want to say here is that there are some deductions that you can claim without receipts, and it's important to understand that whether you are talking about home office expenses, cell phone expenses, vehicle expenses, or travel or business trips, you always have to demonstrate really the importance of the expense. And one thing I also need to say here is that when we talk about certain expenses that you can claim without receipts, is because the IRS has other ways to actually substantiate the receipts to substantiate the expense rather, without having a receipt from you. So when we talk about let me give you an example. When you have self-employment taxes, right? Workers who are self-employed are required to pay Medicare and Social Security taxes. So they're commonly referred to as self-employment, that those have to pay the self-employment tax. You can deduct half of these taxes from your total income, and there is no receipt required, as the IRS will already know if you pay this or not, right? So it's the burden of proof, or the burden of reliability is really low here. You also have educator expenses. So educators are allowed to deduct up to $300 for out-of-pocket expenses related to their teaching or classroom activities. So this amount changes to adjust for inflation. So make sure to find the current amount if you use this deduction every single year. And so this is allowed for any teacher, counselor, instructor, aide, coach, or principal for grades kindergarten through 12th grade. So the constellation of options is pretty large here. And one thing I also need to say here is that there are other tax return documentation you can use if you have no receipts. So remember that most deductions have limits, so you always want to consult with the tax professional if you are unsure about how to go, about making those deductions. But overall, there are some deductions that relate to business. So like advertising, marketing, bank fees. You have business insurance. You have computers and related equipment. You have professional dues or memberships. You have rental equipment used for business. You have certain event costs. You have some startup costs, professional licenses or permits, merchant fees, repairs, salaries, and so on and so forth. So those amounts you can actually deduct without without receipts. But just make sure that everything speaks more to how you keep records, right? It's all about record keeping, and that's important. Let me give you a bonus here. And when we talk about tax deductions you can claim without receipts, it's important to understand that the IRS rules on tax write-offs vary based on the business entity. So if you're an LLC, you'll have different set of rules than if you are an S corporation, and the same applies if you are a C corporation, S corporation, LLC, partnership, and so on and so forth. And so you also need to understand that when we talk about LLC in general, this type of business structure is pretty much more straightforward. And so because it is straightforward and not really cumbersome, you have if you don't have a way to track your expenses, you still can write them off at the end of the year, as long as the IRS looks at your entire business setup and thinks it is solid. Okay, but for other business type entities, you have to really understand that you are able to provide. You can actually convince the IRS that the electronic receipt is also valid when it comes to your business taxes. This is totally possible. There are a lot of businesses that actually report data to the IRS electronically, and that's totally fine. Okay, but one thing I need to really talk to you about, and I want to specify, is that how much deductions you can claim without receipts basically really is capped at the standard deduction, right? Because the standard deduction actually is for those who do not itemize individual deductions on the tax form. But if you itemize your deductions instead of using the standard deduction, each deduction generally has its limits. So if you have any question, let us know in the comment section. One of our team members will get back to you. So when you actually ask questions, and this is for all our viewers, what you want to do is you want to tell us, where you are actually where you want actually sending an email from, where you are commenting from, so your city and state. Then you have to also talk about what kind of so once you give us the city and state, we have a clear idea what applies to you. Then you have to let us know what specific questions you have, and it's one of those things where we'll help you determine whether or not, based on your situation, as you are better off actually filing a tax return with using the standard deduction or itemizing your deductions. So again, everything depends on your income, your adjusted gross income. It depends on your all the activities that you're engaged in anyway. So this is really important. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about what tax deductions you can claim without receipts. So I actually gave you I started with giving you the overview, and then the pro tips, and then we talked about the bonus, and then now the recap. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.